Hi, Joe Cantu here, looking into the future by analyzing the past.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager.
Hi. So let's look into the future by analyzing the past. So we are in a period where inflation from 2010 up until last year, but all the way till 2020, inflation was running at about 2%. But now inflation is running between 5 and 6%. So it's moving up quite a bit. So what I thought I would do in this video is I would say, hey, let's go back in time and look at the stock market during rising inflation, periods of rising inflation. So let's take a look. So if you take a look here in 1979, here you go, 1978, inflation was at 7.6%. Now it's really running about 6% right now, but let's say between 5 and 8. You can just say it's kind of a moving target right now. But that's about where it was. So that's the first beginning of high inflation. And if you look at that, the stock market did 6% that year. But let's continue. So now let's project ourselves into the next year. So into the next year, what was inflation? Let's say that the Fed can't get inflation under control. And so then inflation in 1979, inflation went to 11.3%. What did the stock market do? It did 17%. So you can see that in periods of high inflation that the market does well. It does well because there's growth in the economy. And growth in the economy creates higher earnings, higher corporate earnings for corporations, and eventually the stock prices catch up to those earnings. If you take a look in 1980, the inflation was at 13.5%. And look what the stock market did. It did 30% return. Oh my word, 30%. You know, just a quick story. I remember this 13.5%. So I graduated in 1980 from West Point, and during Officers Basic, I went to Fort Sill, Oklahoma, and I was training to be a nuclear weapons launch officer for a Pershing missile brigade. And my orders were to go to Europe, and Terry and I lived in Europe for 4 years. But during that period where I was training, to I guess take apart nuclear warheads, we bought a house. And it's funny, our mortgage was 13.5%. That's what our mortgage was. It was outrageous. That was the first home that we had purchased. But my point is that look at the stock market did 30%. Now, that's pretty high. Now, we're not even close to that. That's double of what inflation is today. So I'm saying this because I have, I've been talking to several clients, and they think that inflation's going to break the economy. They think that, I know the market has pulled back, but there's other factors that have caused this pullback. This pullback started in November when the Fed just started to raise interest rates. And then the Omicron virus hit, which was the most contagious virus that we've had in this, since I've been living. And it seemed like everybody got Omicron. The nice thing about the virus was, or the only good thing about it was, is that nobody died from it. I didn't hear anyone dying from Omicron who didn't have pre-existing conditions. But then that followed by the Ukraine-Russia thing. And those two events really spooked the emotion of the market. And I'm going to just say something different, that it wasn't that money managers were just removing interest rate sensitive stocks, but they were also removing stocks that they felt that were at risk, or they were taking profits on some of these stocks. So stocks like Amazon and Apple and Google and some of those big companies out there, they were selling them down. They were selling down those tech positions. And I'm not recommending those stocks. I'm just saying That's what was really happening out there. And those are called risk assets. So risk assets to the money manager, to the pension manager, the portfolio managers, because they feel those are high growth stocks, so they have a risk of volatility. So from my perspective, they started selling those positions as well, which caused the market to further start to pull back. But again, by looking at the past, if you go to 1982, where interest rates were 6.1%, again, the market made 6%. Now, I'm not saying that we're in like the 1978 era, but this is the beginning of high interest rates. And I don't know if interest rates are going to move higher next year. But another thing I'd like to say is that if you take a look at, and we'll look, let's go ahead and analyze kind of the current situation now that we've just gone through these last few years. So let me pull up a different chart so we can take a look at that. And this chart is called GDP growth and how it influences revenue and earnings growth. And here at Cantu Tactical, we're all about looking at the GDP, because the GDP is the report card. That's the big granddaddy of all economic indicators. It includes housing, earnings of the S&P 500, savings, consumer price index. It includes everything. Everything is in the one number called GDP, which is the report card. And we monitor GDPs from around the globe of other countries. Now, right this moment, the United States is the strongest country in the world. My prediction is next year, you may have recoveries from other countries, and maybe China might open back up. But I believe that it's possible that next year you could have international countries starting to outperform the United States in their GDP, or as their GDP grows. But let's take a look how GDP growth influenced the stock market. And so I found this chart, and let's see, this chart is from BCA Research. I want to give them their copyright information. So anyway, but what they did two charts. The one on the top is nominal GDP versus sales of the S&P 500. But I'm more concerned about earnings per share. And like we just saw Target's numbers roll out. Now, that was disheartening to see that, because Target didn't miss by 10 cents or a penny. They missed by 30%. That was a lot. That was a big number. And so now maybe it's true that some of the, but yet you had other companies like TJ Maxx, and TJX was the ticker symbol. And so it's almost like people out there are saying, okay, I'm not going to pay these higher prices, maybe at Macy's and Neiman Marcus and maybe even Target. So they're starting to shop at TJX and Ross stores, and those stocks have been doing well. They actually were doing well. I think they were the only two stocks that were up, the last couple of days because of the market. One of the many two. Anyway, so let's take a look from 1990. I want to look at that all the way here until 2022. And what I'd like to share with you is how GDP, the gross domestic product, influences the stock market. But first we're going to say how it influences the overall economy, and then how the market reacts to that. So if we go all the way back to 1989, 1990, what we had there is we had the savings and loan crisis at the same time of the Iraq War. Now, the savings and loan crisis was really started kind of in 1988, 89 time frame. And I mean, that's a long time ago. I mean, that's well over 30 years ago. But at that time, we also had the Iraq War. If you remember, Saddam Hussein invaded Kuwait, and then some of you watching this podcast, you may have been young, but he invaded Kuwait, and then President Bush, we obviously had to kick Saddam Hussein out of there, because by invading Kuwait, he controlled almost 30% of the world's oil, and it was really a major factor. But in that time frame, so the market fell. So or the earnings. Let's say these are the earnings of the S&P 500. So they fell, and then they started to go back up. Now, what's interesting is this dotted line that you see here on my chart is the GDP. This is the gross domestic product. I'm sorry, I have it the other way around. So the line here is growth, is nominal GDP, and then the dotted line is the S&P 500, the earnings per share. So then we had the Y2K crash, and that was in 2000. So, I mean, it was crazy. But I remember Apple stock went to $4 a share. And during that time, they had fired Steve Jobs as well. But, now the stock is a darling stock and one of the biggest companies in America. But we had the Y2K tech crash, and many tech stocks fell 90% in value over that two-year period. So let's look at what GDP was. GDP back then was 1%. 1%. That's what GDP was. It's a very low number. Now here at Cantu Tactical, we have our number that we use. That's a proprietary number. That once that number crosses, then we want to be equity heavy. Now, if that number is low, then we want to be bond heavy, fixed income heavy. And so from basically from as we move forward from 2010 up until from 2000 up until 2013, I was a money manager, portfolio manager, but I was primarily fixed income heavy during that 13-year period. And we actually call that the lost decade for this millennium. And here's an interesting fact. From December 31, 1999 until the January of 2013, those 13 years, if you were invested in the S&P 500, your return was zero. Zero. You made no money. That's right. For over 13 years, if you were in the S&P, you made zero. So what should you have been in? You should have been in bonds. Now that was a period where the economy was slow back then. And if you see this GDP number right here, this is, I guess, 2000, 2001. In 2001, the GDP was 1%. And then if you look at 2002, it was only 1.7. And then you can see the earnings number down here in this dotted line, how earnings went down as well, because it follows GDP. It follows the gross domestic product of the country, which measures, measuring the earnings of the S&P 500 is just one of the components of GDP. Now, the market recovered, but then you had more problems with the economy. And so in 2008, the GDP was minus. It went negative. So you had a minus 0.1% on the GDP. And then in 2009, you had a negative 2.5% on the GDP. So that you had a recessionary period right here on the gross domestic product. And of course, you can see that the S&P 500 earnings, they went down as well, pretty hard. So then, and during that time, the market fell 38%. The market was down 38% in 2008. It was pretty bad. There it is, market minus 38%. There's the number. Then, so then the GDP started picking up. And let's see, 2011. So it was at 2.6%. And then you can see the S&P earnings went way up, looking at the dotted line. So what did the market do? It did 12%. Because the GDP was up. So as the GDP went up, then the market went up as well. The earnings went up on the S&P 500, and then the market caught up to the earnings. All right, so here we go bumping along, but then we had 2015. Now 2015 was, the GDP was 3.1%, but the problem with reporting GDP is you're always looking kind of in the past, so you're looking at past numbers. But at the beginning, for the year, for a total year for 2015, it was to 3.1%. But in 2016, the economy was moving down. There was a trend of the economy moving down, and the GDP fell to 1.7. It got cut in half, basically, lost 50% of its momentum for the economy itself. Now, what's interesting about that is the stock market lost 1%. So it makes sense. If the GDP was moving down, then as well the market was moving down. So the GDP moved down to 1.7%, lost 50% of its value, and so the stock market went down 1%. Now, so that was 15, so 16 it was 1.7, and then of course the market fell 1%. Now in 17, GDP starts moving back up. So GDP increases to 2.3%. Now look at the market. The market was looking really good. These are earnings. These are S&P 500 earnings, which represents the market. And so the stock market itself did 19% in 2017. 19%. That's pretty amazing. Nice double-digit returns in 2017. Again, because we had good GDP, gross domestic product. Now then we start moving into COVID-19. So the pandemic is hitting in COVID-19 at the end of 2019, kind of 2020. What did GDP fall to? GDP fell to minus 3.4%. In March, when the market fell 37% in that 1 week. The market was down 37%, and then it recovered a bit, where I think it ended up March up about 12% just for the month of March, coming back, from the downturn. But no, it was down 37. Maybe I think for the year it was up about 12%, the market for 2020. But anyway, you can see that as the economy recovers and we're coming out of the COVID-19, look at GDP. Now, what's crazy about all these numbers, which I want to point out, because I want to say, let's look into the future by looking into the past. So look at these GDPs. In general, the GDPs are roughly running, when you had kind of a decent market, they're roughly, here's 2.6%, and the market was up 12% right there. So in general, it was roughly running around, maybe 2 to 3%, in a good economy. What's the GDP for 2021? It's 5.7%. Oh my word. The gross domestic product, which talks about the growth of the United States economy, is 5.7% for 2021. That's pretty much double of what the average GDP has been for the last, 20, 30 years? For the last 30 years, the GDP for the U.S. is almost double of what it's been. That's how strong the economy is here in the United States. Now, to curb that strong growth and to curb inflation, and the Fed has stepped in, to try to curb that inflation and raising interest rates to slow it down. So here's what I'm saying, is look at the earnings of the S&P 500, how they're moving up, which is represented by this dotted line right here. Now the black line is GDP. So nominal GDP, or real GDP, is 5.7%, and the earnings are they're doing extremely well. So the question is what do you think the market's going to do by the end of 2022? So, it's my belief that the market is not going to stay down. Now let's take a look a little bit more into the future, into 2023 and 2024 and 2025. So this is just Joe Cantu talking here, giving you my opinion of corporations in the United States. And the biggest thing we want to look at is, it's called CapEx, and that's capital expenditures. In other words, for example, we have Intel. They're building one of the biggest chip plants I believe in Ohio, and It's going to be the biggest chip plant in the world, computer chips. And so with rising interest rates, do you think they're going to stop building that plant because of the cost of money? I don't. I think they're going to continue to build that plant. Tesla with their gigafactories in Texas, I think they're going to continue forward building that. And I think it might almost be finished, actually, when I think about it. So you have all of these companies building, if you look at Amazon, they have 5 years worth of back order contracts for the web, for the AWS, for the Amazon Web Services. And so when you think about that, and that's 2023, 2024, and 2025, I think like Amazon is going to continue to build those factories despite the rising interest rates. I don't think that's going to stop capital expenditures. And if that's the case, then that adds to corporate profits. Now, so in general, what do I think the market's going to do? I believe the market's going to go higher. I can't guarantee that. I don't know that. But that's what I believe. And I believe that based on the gross domestic product of the United States. And it's double what the average it's been in the last 30 years. I mean, think about that. And so if you look at corporate earnings, and these are the S&P earnings right here that you see in the dotted line, I mean, they're doing well. And the biggest, one of the biggest quarters should be the July quarter, because that represents, April, May, and June earnings, rather than these earnings that just came out, which represent January, February, and March, or in the winter, when it's frozen, it restricts transportation and they're not building houses. So in the spring thaw, then they start building houses, there's more transportation. So typically you have more sales, so typically the earnings in July are so much better. So because of that, my belief is that even though the stock market is down 18% year to date on the S&P 500, I don't think it's going to stick. I just don't think so. The corporate earnings are just too good for the United States economy. And as I showed you looking in the past where those numbers were for the market, we're just at the beginning of inflation. We're just at the beginning of those numbers. And so, and if you think about the capital expenditures that 2023, 2024, and 2025 of these companies are going to have, I think that you're going to have continued more jobs. Now, let me talk about jobs just for a moment. In the past, it's been, hey, we've heard here lately in the last year and a half, is that there's 11 million jobs out there, and there's only 5 million people who want to get those jobs, and as a result, there's more jobs than people want to get hired, and as a result, that's kind of driven up prices in terms of wage prices is what I mean by that. But what's the number now? Well, that number's lower now. I believe there's like 6 million jobs out there are waiting, and only 2 million people. So that number has come down, and so you're not having that glut of all these jobs out there. And what's happened is many of these corporations have said, hey, we can't hire these people, so how can we get rid of that position? And that's kind of what's happened. It's made the corporations kind of lean and mean, in another way to say it. So now they've figured out how to continue to build that, to put that product out there without needing those extra employees. And so they just eliminate the job. They say, okay, yeah, we're not going to get anybody, nobody wants to work for that position, so we don't need it. And they found a way to do that. What's interesting about that is that increases the profit margin to a company. Think about that. What's the biggest cost to a company? Let's say you own a flower shop and you have 5 workers. What's the biggest cost to you running that flower shop? It's labor cost. So now let's say you only have 3 workers. Maybe 2 quit, they started some kind of internet job or whatever, and you can't hire those 2 people back. As a flower owner, shop owner, you learn how to run your business, and you learn how to work with just those 3 workers. And what happens to your profits? They go up. Your profits go up because you don't need those employees, or you do without those employees. So your profit margins go up. Your earnings go up. Now, if you're a publicly traded stock, that means that your earnings go up on the publicly traded stock. Now, what do you think the stock market's going to do? Eventually, in my opinion, they're going to catch up with those earnings. I mean, I have been in the business 30 years, over 30 years, and just from experience, I've seen the market through the Iraq War, the Afghanistan War. I've been through the savings and loan crisis. I've been through the Y2K. I've been through the 2008 financial crisis. I've been through the COVID-19. Of course, everybody else has been through the COVID-19 crisis. I've seen periods where the interest rates are climbing. I've seen periods where the interest rates are going down. Now, as I said before, from 2000 until 2013, I'm bullish right now in the market because the market has started a bull run in 2009. And I know I sound like a broken record, but we are in a long-term bull market, despite this sell-off right here. Now, some people can say, okay, we're in a bear market. No, we're not in a bear market. I disagree totally with that. Is the market selling down? Yes, it's selling down. But to me, a bear market is when the market is selling down and, in Joe Cantu's definition of a bear market, and the economy's bad. We're not in that situation. We are in a situation where the market is selling down and we're in an incredibly good economy right now. Despite the inflation, we're in an incredibly strong economy. Eventually, I believe the markets will catch up with the numbers. They always do. They always do. Now, so could you call this a correction? Yeah, you can call it a correction. It's a sell-off. And so, yeah, the market's down. But do I think it will stay down? No. Now, let me say one more thing. So many of you out there, and this is a public video on YouTube, so anybody in the world can see this video. So many of you have lost a lot of money. You've lost 20% of your portfolio. And if you're looking at November highs, you've probably lost maybe 25, maybe 27% of your portfolio. So you're down almost 30%, 25 to 30% from the November highs. Do I think it's a permanent loss? No, I don't. I don't have one bone in my body that thinks that. Again, I have been through 2000 and the financial crisis. I know when the economy's bad. And when the economy's bad, the Fed is lowering interest rates. They're lowering interest rates. Interest rates are going down. They're trying to jumpstart the economy. So how do they do that? What happens? By them lowering interest rates, so it makes somebody qualify for a home. Now, right now, they're raising interest rates, so they want to put the brakes on the economy. They want to curb inflation. You know what? It's working, because now mortgage rates are going up, less people qualify for a home, and because of that, it slows down the housing market. That's what they want to do, and they want to do that because there's high growth in the economy. Another thing about these Target earnings, them missing numbers. Now, Target and Walmart both miss numbers, but in some ways you could say that maybe it's an aberration, or it's an isolated event, to those two companies. Now, one of the other things they're not mentioning is how much retail sales they lost from online retail sellers like Amazon.com, for example. So they're not talking about that. In Walmart's case, they said that they didn't want to raise prices in the store to drive off customers, so that hurt their earnings number. Okay, I'll buy that. Great on the CEO, but you missed earnings numbers because of it. Because normally, rising interest rates don't really affect many of these companies, because they just pass on the rising price over to the customer. So, also in some ways, I was looking at some of the news, and it said, maybe it's good, that companies like Target, miss numbers, and it kind of shows the Fed that the rising interest rates that they're doing, their policies, is working. But I don't necessarily equate that, to be legit. But I do think that the customer themselves are making the decision maybe not to buy those high prices. I know on automobiles that, the used automobile market is outrageous. It's gone way, way up. And I was reading some news reports saying that, now some of the customers are saying, I'm not going to pay that high price for that used car, much less a new car. And they're deciding to take other modes of transportation, either Uber, ride the bus, or just deal with their old car and get it repaired. And that might be, if you look at some of the auto stocks like Advanced Auto Parts and O'Reilly, those stocks have been doing fantastic. I think that for example, that those two stocks are doing fantastic because people are refusing to pay these higher prices for some of these used vehicles and some of these other cars. So I guess in some ways, the market, is slowing down. Now the Fed is trying to slow down the market, and it's working. Now let me talk about this concept about slowing down. So let me explain that for the public or people looking at this, what that means. So say you have an automobile and you're traveling from, say, here in Miami all the way to Chicago, and you're doing 70 miles an hour. And say that car represents the economy, the U.S. economy. What they mean by that is that you're going to take your foot off the gas, and instead of going 70 miles an hour, you want to slow it down to 60 and then to 50 miles an hour. So you still have growth in the economy, but you're not going into recession. You're not doing that. Slow growth does not mean recession. It does not mean that. They're just trying to slow down inflation and slow down the economy to a consistent level of, say, 2 to 3% inflation, which is more desirable. I'm just saying that from experience. When they say slow economy, they just mean they're slowing down the economy. It doesn't mean that they're going to slow the economy and wreck it into a recession. Let's talk about recession just for a moment. Let's talk about what that really means. So what's a recession look like? Do you guys remember COVID-19? Do you remember the airports that were empty? A recession is when the airports are empty, when restaurants are empty, and nobody is shopping. That's a recession. So do you think in 2022, by the end of the year, and in 2023, and 2024, and 2025, that you're going to see that environment again in the United States or around the world? I don't. So I don't see a recessionary period. I don't see that out there. So, I mean, that's what you need. And when you have that, what do you think the Fed would do then? They would start to lower interest rates. They would lower rates. So if they're lowering rates, then the economy is in trouble. So when the Fed lowers interest rates, the economy is in trouble. Then you have to worry about the stock market. What do? We move to fixed income bonds, utilities. We move into asset classes and investments which go up when interest rates go down. Now in this environment, bonds are going down. Let me talk about bonds just for a moment. So I've noticed that there was a chief investment officer, I believe, I don't remember his name, but I think he was from Guggenheim. And they're a big bond manager out there. And he released a press release. I mean, it went out on public and saying that the Fed could be raising interest rates, pushing the economy into recession by year end. That is absolutely ludicrous. Now, when he's talking and on television, or when he's making the statement, you got to realize who's making that statement. He's taking a hit. His bond funds are losing money because the Fed is raising interest rates. And because of that, what is the guy going to say? He's going to say that, the Fed's going to wreck the economy and he's raising rates too much. Well, when you raise rates, what goes down in value? Bonds. His bonds go down in value. So now, and the other thing that I noticed that he said is that he believes that interest rates have topped out. He believed that maybe the 10-year Treasury won't go above 3%. Now, I don't believe that. I don't believe that because the Fed has said they're going to raise interest rates another 0.5% probably in June here. And then they may do it maybe another 0.5 or 1/4 by September. They're going to look at the economy to see if it's slowed down or not. I mean, I don't know what they're going to do. But my point is I do believe that interest rates are going higher. I do believe the 10-year Treasury will probably hit about 3.5%. I don't know if it will, but that's what I think it will. And I believe interest rates and mortgage rates are going up even higher as well. So with that respect, will his bond fund take a bigger hit? Absolutely it will. But in my mind, a guy like that, who's chief investment officer of a big bond fund, all he does, he's just trying to ease concerns to all of his customers that they're not going to lose any more money in the bond fund. But I don't think that's true. I think that they will lose more money in their bond fund because I think that interest rates are going higher. Well, we know they're going higher. We know the Fed's going to raise interest rates. And so, because of that, bonds are still a negative asset class to own in your portfolios. So where should your money be? It should be in equities. That's where your money should be. It should be in equities. Now, here at Cantu Tactical, we've made some small asset moves in our portfolios. We've added, I don't want to get into the details about exactly what we've done, but we've done some things in the portfolios to basically put a Band-Aid because the market is selling down, and with target missing numbers, that really changed the dynamics to the market. Up until target missing numbers, yesterday, and especially the way they missed them so poorly, it's just the market has just been selling off, in my opinion, emotionally. Again, money managers are removing risk assets and removing interest rate sensitive stocks as well. But it's been more of an emotional sell-off for the market up until yesterday. Yesterday was the first time that, in my opinion, that Target indicated that they missed numbers because of rising inflation cost due to transportation costs. Now, they were pretty honest, and they said that they carried a lot, and Walmart did too. They said they carried a lot of inventories longer than they should have, and that because of the colder months that we had in this last quarter, that they carried that things like grills and outdoor chemicals for your swimming pools, those things didn't sell. So because of that, they said that was the main reason that earnings were affected. But the key thing in all that conversation, the takeaway that I got out of it, is that that's the first indication that, quote, inflation was a factor in hurting corporate earnings because of the price of energy. Energy. Let's talk about that. Now, I'm not going to get into that in great detail. You have your opinion on energy. You have your opinion. Do you think gas prices are going higher? We do know that Biden shut down two major, fields, oil fields that were in government control, and is not allowing drilling on that. And obviously on that, then that's affecting the prices of energy, and it's causing the price of energy to move up as well. We've also seen like green theme types of positions, such as clean energy. Let me just say that those types of security, solar and clean energy, and we're seeing those move up as well. Anyway, my point is that you have your opinion on energy. Has it peaked? I'm not so sure it has. I think it's toppy. I think it's kind of at a high, and it could have peaked. The other thing to remind everyone is that up until about a year and a half ago, energy fell for 7 years in a row. Now, why is that important to understand? What's important to understand is Russian oil came into the world in the late 90s. Russian oil is the cheapest oil in the world. You know, we had Petrobras and Petroleum of Brazil. You know, they had some pretty cheap oil, and you know that oil kind of came into the market. If you remember back in the 90s and before the 90s, from the 70s up until the mid 90s, OPEC controlled the world's energy prices. I mean, they pretty much are the ones who decided if they were going to increase the price of oil per barrel or decrease it, and they had that kind of control. But once Russian oil came into the market, it was the cheapest oil in the world. We started even buying Russian oil here in the United States. It destabilized the entire oil market, and so oil, you know, just fell over time. And you know, we saw ExxonMobil, for example, fall from $100 a barrel all the way down to I believe $100 a barrel. Fall from $100 a share down to, you can tell I'm a Texas boy, fall from $100 a share all the way down to $31 a share. And now that stock's, you know, moving back up, which is nice. But what's caused it to move up is the fact that now Russian oil is out of the market. Okay, that's important to understand if you own energy stocks. Because if you own energy stocks, if things get back, and I don't know if they will, but let's say down the road, 2023, 2024, 2025, you know, look at oil. Let's take a long-term look at oil, at the energy industry. If things start getting back together with Putin and start being kumbaya again, and Russia oil comes back into the market, where do you think oil prices are going? They're going down. That's where they're going. They're going back down. What are oil stocks and energy stocks going to do? In my opinion, they're going to go down. But as long as Russian oil is out of the market, that's positive for the energy industry. And it's positive for energy stocks. And so energy stocks are still, you know, a darling position to hold in your portfolios as long as Russian oil stays out of the market. Well, I've kind of exhausted my time, and that concludes my this video. I have some disclosures that I have to give that are required by the state securities offices of the different states that we're registered in. Please take a listen. Thanks.
Welcome to Retirement Tactical Money Management. Joe Cantu, Chief Investment Officer of Cantu Tactical Wealth Management, is your host and has over 30 years of experience in the retirement money management profession. He is a West Point graduate with a master's in business administration and has worked for 3 of the largest Wall Street firms as a stockbroker and portfolio manager. Over 10 years ago, he created Cantu Tactical Wealth Management, which actively balances and selects investments based on a tactical approach rather than the traditional strategic management method. Instead of the buy and hold philosophy, he believes in the pursuit of finding investments showing momentum, performance regardless of the direction of the market. His experience includes IRA accounts, 401k rollovers, trusts, endowments, defined benefit plans, 403bs, and 401k plans. Additionally, he served as a night college instructor for seniors, teaching high net worth retirement and estate planning for 14 years. Podcast views and personal opinions are for educational and entertainment purposes only and does not constitute a recommendation. Investing has risk of loss, and you should consult with your own advisors for any financial decisions. Cantu Tactical Wealth Management is a fiduciary, registered investment advisory firm in the states of California, Florida, Georgia, and Texas, providing pure independent advice and money management.